Well, broadly speaking, as we've been into earnings season, they've been treated as a reason to sell versus a reason to add. Air Canada is a perfect example of that. Let's bring in Tim Regan, who's Managing Director and Portfolio Manager from Kingwest and Company, to talk stock specifics and kind of macro trends out there. Tim, thanks so much for being with us.
Thank you for having me, Amber.
So Air Canada is kind of perfect example. I mean, that was a really big, high-quality beat, but then nervousness about, well, can you continue this?
Well, no, you're absolutely right. The market is very pessimistic these days. People are pessimistic. Looking forward into 2024, we see there's a lot of issues with Air Canada, like inflation, fuel, geopolitical, general economic slowdown, but it is trading at a very, very low level. Sometimes when there's pessimism in the market, you can't stop it.
And yet, and I made this point earlier, when everything was going right for the airlines, demand, pricing power, no clouds on the horizon, they still didn't re-rate to back to where they were before the pandemic. Now there's concerns. How are they ever supposed to outperform?
Well, it's interesting. I think it may just be a change in attitude as well. But don't forget, the market's always forward-looking, so people are very afraid of what will happen next year. We think a lot of the fear is undue or priced into the market today. And in fact, we're seeing Canadian equities, our portfolio in particular, is a phenomenal buy today.
Canadian equities have been a frustrating market in 2023. How have you navigated that up until this point? And it sounds like you are, if not voraciously, but definitely adding to your exposure here.
Well, we are. I mean, when we look at it, we have to look out, not just tomorrow, but the next 2 to 3 years. And this is the biggest value gap in our Canadian portfolio we've seen since the bottom of 2009. We think the business values in our portfolio are 70% above where they're trading at today. And we think that should happen 70% above. And we think that should happen in the next 2 to 3 years.
Why? What do you think is going to happen to get attitudes to change?
Well, we have 2 to 3 years to have attitudes to change. Rates will normalize. Are they going to hold at 5%? Will they go down next year? I can't tell you that, but it looks like inflation's calming down. It looks like rates are normalizing. But let's presuppose we have 5%, 4 or 5% 10-year bonds going forward. That's not bad. That's a reasonable price of money. And we shall see what happens when that happens.
Now, you're not getting cute in the portfolio looking for obscure names for alpha. I mean, you're going right to the heart of our index, which is those bank stocks. I mean, they look... It's hard not to do your homework on them when you look at valuation and dividend yields, but concerns about the macro picture certainly seem to be keeping investors at bay.
Well, if you look at it today, the concerns about the macro picture, we feel, are more than priced in the securities. And don't forget that the macro picture, whatever happens in the next 2 or 3 months, it will be a different story in the next 2 to 3 years. And, we're not just seeing in the banks as well, but we also have a position in TMX. And so if you look at that, they report tonight, and that's been doing all right. I know you're probably going to pull that up right now for us.
Well, it has been doing all right. Yeah, you're right, compared to it's held in.
And so you're looking at a marketplace that seems to be very, not just pessimistic, but doesn't want to buy right now. Now, I'm generalizing because there's millions of different viewpoints in the marketplace, but it is a very pessimistic market. Well, best opportunities.
I want to unpack the opportunity in the banks. There was a report today by RBC quantifying this shock we all know is coming, and we're trying to figure out how big is it. 60% of all mortgages in this country in the next 3 years will be up for renewal. RBC estimates $186 billion worth just in 2024 alone, $315 billion worth in 2025. And this is just what's sitting at the banks. And they're all going to perhaps renew at rates that are 30% higher. Now, there's a lot of assumptions there. And that category, there's all kinds of tiers. But it's something that you have to pay attention to. How do you think about that mortgage risk as it relates to stepping into the banks today?
Well, I think a lot of it's priced into the banks today. We've seen them really fall off. But at the same time, the banks as well, you're going to get mortgages come to a level that is more realistic than we've seen. Having 2-3% 5-year mortgages was a little unrealistic, but also bank spreads are wider. It's hard to make a spread off of a 2% mortgage. If you have a 5.5%, 6% mortgage, banks can now make spreads. Will it cause some harm in the economy? Absolutely when you take that away, but how much harm, and is it priced in today? That's the big question.
So you're buying the unloved banking sector. What other unloved sectors are catching your interest?
I mean, some of the other unloved sectors very slowly is real estate as well. We've seen the baby being thrown out with the bathwater. Real estate has the same concerns as the banks with higher rates, but we're seeing some fantastic companies trading at prices we haven't seen before. We have smart centers, which is down quite a bit. One other one that I'll say has some global real estate, which is not a real estate company, but Brookfield.
Yeah.
So we're seeing some very, very good companies trading at extremely low levels.
Brookfield is interesting. I mean, it's such and you're talking Brookfield.
Brookfield,
not
yes.
Brookfield Asset Management.
Correct.
They've got their hands in a lot of things. And one thing that has stood out is how active they have been at a time where so many other private equity players have been more subdued. Are you generally thinking they're making the right moves, they're constructive, or why are they the only ones out there?
Well, I don't think they're the only ones out there, but if you look at where the marketplace is today and where they're going into, you can pick up things fairly cheaply. We're hearing a lot about the private equity companies going in to look at whether it's real estate, private equity, whatever it is, and sometimes you're going to see a delay in them pulling the trigger. But with asset levels where they are today, it seems very enticing if you're a long-term investor. If you're not,
it's a little tough. What are you staying away from?
I guess right now we're staying away from materials today. It's hard to see with this commodity cycle. At one point we did own First Quantum about 2 or 3 years ago, and we've seen First Quantum move all over. So it's a good thing we're not in it today. But at the same time, you are seeing more solid, less cyclical businesses trading at very low levels. So looking away from some of the commodity-related ventures, which can swing at any point, and looking into more solid, stable revenue businesses.
Like what?
Like the financials.
Yeah.
We have, as I said, we have positions in telcos as well. And so if you look at those types of businesses, they're the solid businesses which we want to own today, especially after they've been beaten up.